Hi there, welcome to Kneppy Invest. On March 27, 2023, I released a video on Brookside Energy. The main catalyst for me doing that video was this company's December quarter results. In particular, because this company's financial year finishes at the end of December, particularly the operating cash flow for the full financial year, which was just above $30.5 million. And when I compare that operating cash flow for this company to the market cap, which is $60 million, and the enterprise value, which is $27 million, I can't really grapple in my mind how this company can, on the surface, look so cheap. If you looked at the PE ratio or the EV to EBIT of this company, it looks ridiculously cheap. So there has to be something else going on with this company for it to seem so cheap. And then on March the 31st, after the markets had closed for the day, something like 7 p.m., the company released their full year results. And these are crazy financial numbers in terms of the current valuation of this company. So I just had to do another video because it just seems so good, too good to be true. Now, just a few facts in regards to Brookside Energy. This company is an oil and gas producer. Yes, this company is bringing in revenue, bringing in cash flow in their projects within the Anadarko Basin in Oklahoma. And that's the other interesting thing about this company is where they do have their operations is just near where I used to live. In fact, where I lived for about 4 years between 2001 and 2005. This company listed on the ASX in October 2005, coincidentally enough, as Red Fork Energy, and then they changed the name to Brookside some time ago. I don't really care about the history of this company, but right now they are Brookside Energy. The current managing director is David Prentice, and he has 2.2% stake in the company, which doesn't seem too high, but at least there's a little bit of skin in the game. And I think one of the major issues of this company is the shares on issue. Currently, they have 5 billion shares on issue. And one of the main reasons I probably would not buy into this company right now is just the very fact they have 5 billion shares on issue, and the very fact that the share price is 1.2 cents. And because this company has 5 billion shares on issue and the share price is 1.2 cents, what's happening now and what's driving the share price up by 0.1 or down by 0.1 cent is just pip or day traders. They only care about that increase or decrease in the share price of 0.1 cent. So this is a plaything of day traders and pip traders. And that's a valid reason why I'm not interested in taking a position in this company just yet. And this company has an enterprise value of $27 million. For those who don't know, to get the enterprise value, you get the market cap of the company, which is the shares on issue, times the share price. You add debt and take away cash. This company had something like $33 million of net cash on their balance sheet, which means the enterprise value is $27 million. I'll talk about that again later in the video. And the ticker code for this company is BRK. Now let's have a look at the company's interesting financial statements. Now, usually I start with the cash flow statement and then work my way back. But in today's video, I'm going to start at the profit and loss statement, look at the balance sheet, and then finish up with the cash flow statement. So this is the profit and loss statement. A few things we want to take into or look here is the increase in revenue. So revenue went from 12.6 million to 53 million. So nice increase in revenue. Now, most of their expenses are royalties expense. That was 26 million. So if you look at the gross profit, this company had gross profit of $26 million. And they don't spend a lot of money on other stuff. $1.4 million on director employee related expenses, $6 million on amortization expenses, $1.4 million on share-based payments expense, and those are the only expenses above $1 million, which means this company was profitable after income tax, which was zero, and that's something also to be aware of $15.1 million, and that's before the translation of foreign operation or the exchange differences in the translation of foreign expenses, which was $3.5 million. So if you take that into account, this company was profitable by $18.6 million in financial year 22. Now, I like to be a little bit conservative here because exchange rates can go in your favor or against you. So I don't like to take that into account. So I do like to use the number of $15.1 million as a profit for the year. So again, this company has a market cap of $60 million and a profit of $15 million, which means simple mathematics. The P ratio of this company is 4. And we can see that also with the earnings per share, 0.35. Share price is 1.2. You divide 1.2 by 0.35, and you get almost 4. So again, this company has a P ratio of about 4, which seems too good to be true for a company that is growing, for a company that is profitable by $15.1 million. Now let's have a look at the balance sheet. So first thing I always look here is cash on hand. $33.9 million of cash, $4.2 million in trade receivables, which means they have total current assets about $38.3 million. Significant increase in last year, which was $18.4 million. Overall, they have total assets of $93.8 million, total liabilities of only $22.1 million, which means that total equity or net assets have almost doubled from last year, from $36 million to $71.7 million. Now, something else to take into account here or notice here is the increase in trade payables. They did increase from $4.7 million to $22 million. So that could be a reason why this company was highly operating cash flow positive. So you do have to take that into account. And that also explains why there's a big difference between the operating cash flow and the profit for this company, which was about $18 million. It's just that change in working capital, that change in trade payables. Now to the cash flow statement. And the first financial statements I typically look at is the cash flow statement, and then I work my way back. It's just what I do. And one of the reasons I do that is because the cash flow statement is less likely to be manipulated by accountants. Now, when I say manipulated, I mean legally manipulated. Manipulations of financial statements happens all the time, but you just see it less in the cash flow statement. Doesn't mean it doesn't happen here, but you just see it less and more likely to see it less in this statement. Now, some of the things I do look at here are receipts from customers, of course, but I just want to see where the cash is going to from their operations. And we can actually see that in Brookside Energy's cash flow statement. So cash from operations, $33.6 million. Payments for exploration activities, $23.8 million. Payments for production assets, $7.9 million. So even though they were operating cash flow positive by $33.6 million, they almost spent all that operating cash flow. And this is exactly what management have to decide to do on a daily basis, what to do with the operating cash inflow into their business. And for this company, management have decided to pay for exploration activities. They could decide to pay for dividends, share buybacks, or maybe acquisitions. The other thing to notice in financing activities here, this company received $16.2 million through the proceeds from exercise of options. I had a look, there's no more options to be exercised, and that did help the balance sheet because that increased the cash on hand by $16 million. So that's why the cash on hand at the end of the year was $33.9 million. That also increased the shares on issue from something like 3.3 billion to 5 billion. But thankfully, no more options to be exercised, if I remember correctly. But overall, $33.9 million of cash on hand at the end of the financial year. Now, in my opinion, this is just my opinion, the most important job of the CEO, apart from maybe cultivating culture, that silly sort of thing, is deciding what to do with the cash flow generated by the company's business or operations. This is probably the hardest thing for a company's management or CEO to decide what to do. In fact, I would say a lot of CEOs out there are not good capital allocators. So some of the things they could decide to do are share buybacks, dividends, acquisitions, or for Brookside Energy, exploration. We already know, based off the previous slide, based off the cash flow statement, that they've decided to go down exploration route. But I wouldn't be disappointed if this company decided to do some share buybacks, just because how ridiculously cheap this company seems to be. I would not like this company giving any dividends. I would not be surprised if this company went down the acquisition route either. But it seems like they're focused on exploration right now. I could be mistaken. Maybe they have some other plans, further plans in the future, particularly around acquisitions. I doubt they would be thinking about dividends right now. And maybe the share buyback has been flickering in their mind just because how cheap this company seems to be right now. But it seems like exploration, maybe acquisitions, is what this company has decided to do with the cash on hand in this business and the cash flow generated by their operations. Now to some crazy valuation numbers. So this company has a market cap of $60 million. That's at a share price of 1.2 cents. I am recording this video at 3:45 p.m. local time. So the market hasn't quite closed for the day. Last time I looked, the share price was about 1.3 cents. So there was a bit of a lift in the share price today because the market was a little bit excited, not greatly excited, but a little bit excited about the financial year numbers for this company. So at a market cap of $60 million and an enterprise value of $27 million and a profit of $15.1 million, the P ratio of this company is 4 and the EV to EBIT is around about 1.8. In fact, if you looked at the EV to EBITDA, it's around about 1. So those are ridiculously small valuation metrics for the company. So that does raise quite a few questions for me. Why? And the main question is, why is this company seemingly so ridiculously cheap? So my main question when it comes to Brookside Energy right now, when you look at those valuation numbers, is why is the valuation seemingly so low? There must be an explanation right now. Is it as simple as shares an issue of 5 billion, share price is 1.2 cents, so you have a lot of pip traders, day traders out there who are just trading a change of 0.1 cent in the share price of this company? Is it as simple as that? And if it is as simple as that, the solution is really easy. All the management have to do is a share consolidation to decrease the shares on issue from 5 billion, say 500 million, maybe 100 million. And that way you increase the share price to, say, a range where pip traders and day traders are no longer interested in this company. For example, if you did a 10-to-1 consolidation to decrease the shares on issue from 5 billion to 500 million, the share price would then be 12 cents. So you don't get a change in share price of 0.1 anymore, and you automatically eliminate all the pip traders. The question is that the reason why the valuation is so low? Or is there other reasons out there that could explain why the P ratio of this company is 4 and the EV to EBIT is less than 2? Now, some of the things I would like to see, apart from a share consolidation, is I want to see management buy some shares on market. That would give me confidence that even the management believe the shares or the valuation of this company is ridiculously cheap. But we haven't seen any management buy shares on market in the past 6 or 9 months. Maybe they have, maybe a year ago. But I'd like to see management have a little bit more confidence that the valuation of this company is too low right now. And if we do see a lot of management buying shares on market, that would be a really good sign moving forward. Now, another interesting thing happened in the oil sector overnight when the Saudi Arabia, or just Saudi Arabia, decided that they were going to cut production, and we have seen oil prices rally up about 5% from the previous day, and currently the oil price is hovering around $80 a barrel, and that's a significant increase from what we saw a few weeks ago when oil prices got down to about $64. So this could be a good sign moving forward for Brookside Energy, and maybe the weakness in share price we have seen in this company, maybe the reason the valuation does seem so low is just because oil prices have been in a downtrend over the past 9 months. And if this has put a stop to this downtrend, that can be only good news for Brookside Energy moving forward. And that's all I have for this video on Brookside Energy, my second video on this company in 1 week, which is crazy indeed that I'll do 2 videos on an oil producing company that has operations in Oklahoma, 2 videos in 1 week. I am going crazy, or maybe the valuation of this company is crazy enough for me to do 2 videos in 1 week. If you have any questions at all about this company, love to hear them. If you have any thoughts about Brookside Energy, love to hear your thoughts. So leave in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.